Welcome back to Strictly Money. This is not the retirement I had envisioned. This is what many Canadians living in their golden years are saying in light of today's high inflation and high interest rate environment. And let's face it, managing one's retirement funds is not easy at the best of times. But when you don't have a paycheck rolling in, when you're spending way more than you imagined, and when you see your investments sink, it's stressful. If this is you, stay put, because my next guest has plenty of advice on how you can manage your retirement plan in today's uncertain times. Jason Heath is a fee-only financial planner with Objective Financial Partners, and he joins me now. Jason, great to have you back.
Yeah, thanks for having me.
Understandably, right? A lot of seniors are stressed. And the interesting thing is it's high interest rates and high inflation is not something new to them. They've experienced it perhaps decades before, but probably when they were working. So what are your clients asking you about, and what specifically worries them?
Well, it's funny. I've been practicing as a retirement planner for probably 20 years, and I've had more questions about inflation in the last 6 months than I've had in my entire career. I think a
Wow.
big part of that is inflation has been relatively low and under 2% for most of the last 20 or even 30 years.
Hmm.
And all of a sudden, we're in a real high interest rate environment or a high inflation rate environment. Another thing that I've noticed as well is investments. Lots of people concerned about their investments. And it's funny because when the pandemic first started back in 2020, stock markets fell a lot more and a lot quicker than what we've seen over the course of the last 6 or so months. But I think because it's been a slower, more drawn out decline in stock markets, it's given more people more time to reflect and worry. And that's certainly coming across in questions and discussions.
Yeah. What are current inflation expectations that retirees do need to consider then, Jason?
Well, I think if we start with where we're coming from, Statistics Canada just came out yesterday and announced inflation hit 8.1% year over year for June. It was actually a little bit below expectations. So I guess that's the good news in an 8% interest rate or inflation
Yeah.
environment. Down in the US, 9.1%, the UK is 9.4%, a lot of other countries dealing with the same thing. I think that as far as expectations, it's very unlikely that we're going to see an 8 or 9% inflation environment persist for a long time. Not to diminish the impact that it's likely to have on people over the course of the next year or two while the Bank of Canada gets inflation under control. But I think as far as long-term retirement planning, we're more likely to see an inflation rate of 2% over the long run, even if the next couple of years are difficult. And the people I think that are most at risk, frankly, are those who are retired and living off of defined benefit pension plans that are not indexed. So a lot of public sector employees have inflation protection on their pensions, but most private sector pensions, people who work for companies, do not have any inflation protection. In the last year, they've seen 3, 4, 5 years of purchasing power disappear,
Yeah.
unfortunately. So hopefully that gets dealt with sooner rather than later.
And that's a question I wanted to ask you, right? Because the revenue side or the income side is pretty much fixed for most
Mhm.
people,
Mhm.
unless you're working part-time, and that's not realistic for a lot of people. Can they expect a bump up in CPP payments then? And
Yeah,
yeah,
CPP and old age security, the Canada Pension Plan retirement pension is indexed and increased with the cost of living in January. It was only increased 2.7% back this January, but the full inflation that we've seen, particularly in the last 6 months, wasn't baked into that. So we'll likely see a CPP increase next January that is in line with the cost of living increase. Old age securities increased quarterly, actually, so people see their payments go up quarterly, and that provides a degree of inflation protection for all retirees because most of us have some CPP and old age security pension we're entitled to. Investments to a certain extent, both stocks and bonds in the long run benefit from higher inflation. In the short run, we've seen how they have not so far this year. So again, most of us have some inflation protection in our government pensions and in our investments in the long run.
yeah, and I think that's important to note. Although we know that CPP doesn't cover enough of your living expenses, right? It's only
Yeah.
really meant to cover about 30% or 40%. Jason, we'll continue this conversation because I want to get into your thoughts on how people can plan for the stock market and the uncertainty there. We're going to take a quick commercial break, and we'll
Sure.
be right back. Welcome back. Jason, so we were talking about markets as well. Should investors sell their stocks in anticipation of a recession? And what do you do right now when you see your portfolio, turn into the red?
Yeah, well, look, it's been a tough year for investors, and actually, it's been almost a worse year for conservative
Hmm.
investors because the Canadian bond market was down about 12% for the first 6 months of the year. Canadian stocks were only down about 10%. So some more conservative investors have seen bigger losses than the more aggressive ones, which is a strange phenomenon. I think that something to keep in mind is that market timing is very difficult. Even the professionals, picking the right time to buy and sell is about as easy to do, or about as likely as a coin toss. So, in order to pick the right time to sell and then pick the right time to buy back in, you need to be right not just once but twice.
Yeah.
So, something I'd be inclined to encourage people to consider is, the losses that you've seen in your portfolio so far are temporary losses. They're only permanent if you sell and make them into permanent ones. And I think with lots of people, when you look at their time horizon, even if they're withdrawing from their investment portfolio, they might only be taking out 2, 3, 4, 5% per year. That means the other 95, 6, 7, 8% of your money is still invested in order to recover. So if you're nervous about markets, it's a time to reconsider your risk tolerance. But I don't think to make any sort of a wholesale change and get out of the market. Stocks are already anticipating the bad news. And even once a recession is announced, if that happens, stocks could already be rising in anticipation of a
Yeah.
recovery.
Yeah, exactly. Jason, GICs, because nobody wanted to put their money in GICs. They weren't getting a return. Are they a viable option now for investors and especially retirees?
I think so. I think it's part of the bright good news, or the silver lining with interest rates going up, that we now do see GIC rates, 5-year rates, up over 5%. Even 1 to 4 year GIC rates are well over 4%, and we could see them continue to move higher. Now, that still provides a negative real rate of return when
Yeah.
you've got inflation at 8%. If you're earning 5 and inflation's 8, you're -3 after an inflation adjustment. But I think the likelihood of inflation staying high, as I mentioned, is low. The Bank of Canada, in their July monetary policy report, suggested that we should be back down to 3% inflation by the end of 2023, and their 2% target by the end of 2024. So inflation, again, is hopefully a short-term phenomenon, but these higher GIC rates, I think, are likely here to stay and are a real viable option for conservative investors that are easy to understand, and finally, for the first time in about 15 years, paying a great interest rate.
I also wanted to ask you, Jason, what about annuities? Are they coming back in
Mhm.
favor as well? And would you recommend them?
I wouldn't say they are coming back in
Oh, okay.
favor. They will come back in favor. I think these higher interest rates. I've talked a lot to people about annuities as of late as well. They were big back in the 70s and the 80s when interest rates were more appealing. But I think as interest rates continue to rise, and as we've got more baby boomers moving into retirement, an annuity is a product that is provided by an insurance company where you can take a lump sum of money, hand it over to them, and based on your life expectancy and interest rates, they'll make a monthly payment to you for the rest of your life. So higher interest rates mean higher annuity payments, and it's a great way to provide a simple retirement income and insure against the risk of living too long. Because if you live to 110, the annuity keeps on paying. The annuity market in Canada is relatively small, but I think we're going to see demand increase just because of the baby boomer population and higher interest rates. And I think that could be a good thing for the retirement income planning market.
Yeah, and I guess especially for those who get nervous, right, and they want that certainty, it's certainly a viable option. Jason,
For
we really
sure.
appreciate you coming on today. Thanks so much. Well,
My
we'll
pleasure.
get you back again.
Thank you.
Jason
Thanks for
Heath of Objective Financial Partners. Well, that wraps up this episode of Strictly Money. You can find previous shows on the newsforum.ca or subscribe to our YouTube channel. Thanks for watching. Until next time, stay well, stay wise, and stay wealthy.